Fannie Mae Data that this is a bad time to buy a home. So if you're asking that question, you can see this goes in cycles, and I would wait until the pink line got closer to the bottom and the black line were higher. That would, in general, tell you this is a good time or not a good time to buy a home. Let me get this clicking going here. There we go. And this is also a chart that shows the same thing on a net percentage good time to buy. And you can see it's definitely negative. And if you went back, pre 2020, even during 2020 a little bit, it was a good time to buy. But now it is, shall we say, not a good time. The younger people are increasingly pessimistic about home buying conditions. And of course, this chart actually somewhat correlates with the previous two charts. But if younger people are saying this is not a good time to buy and they're pessimistic about it, uh, I guess you'd say wait it out. Things tend to go in cycles, and there will come a better time to buy. And sometimes we can't see it from here or know what will cause it, but you'd want to wait until these indicators turn positive. This is an interesting chart that shows the cycles of inventory. And if you follow housing, you know that in the early part of the year, there is homes start to be listed, there is an excess or an adequate supply of inventory, and then by July, that inventory gets depleted somewhat, and then uh, home sales go back down, start to go down. Inventory goes back up in January, and then the cycle starts over again. You can see I put arrows on the left side of the chart. The first four arrows show that the um, January periods where there is um, uh, the better from more availability. And the then by excuse me in January, and then in July the inventory gets depleted. If you go to the right of the chart, you can see that the going to the pandemic, the low point there was in April, and the inventory did not go back up. The inventory continued to get depleted so that that cycle, the one with a circle around it in 2020, was lower than the previous 4 years. And then look at 2021, it just dropped. And in normally when it would go back up, there was an excess of inventory in January. That didn't happen. So it just continued to decline. And then here we are in 2022, uh, very low inventory. And um, so the cycle starts over again. But the um, uh, excess inventory is not similar to previous patterns for a variety of reasons. I'm going to jump over to the manufacturing component. Our manufacturing uh, index is tracked on the gray line. This is overlaid and is actually fairly similar to that in China, except until recently. Recently, China is struggling in many areas in their economy. We know their banking sector is struggling. It's always been under siege. The currency is has always been questionable because of the way the party props up the currency. And then recently we've seen the real estate from Evergrande and other real estate developers just um, collapsing. So the manufacturing sector is also collapsing. So militarily, we look at China and consider China a threat to the US. However, when you get over into the manufacturing sector or in other sectors of their economy, um, there's no way you could look at it without saying they're headed for trouble. This is the result of a survey from the NFIB, National Federation of Independent Business, and they do an optimism questionnaire for small business owners to asking them how optimistic are you for sales going forward. And you can see since 2018 this has generally speaking been in a period of decline. I drew a red arrow to show you the general direction from 2018 to present. Small business owners are not optimistic um, at this time. I guess you could say they're pessimistic. This is another survey. This is the University of Michigan survey. It's the confidence indicator. It's what's used from a survey standpoint is what's used probably more than any other survey, and it's an overlay showing the black line shows that those who are concerned about COVID from a confidence standpoint impacting the economy for consumers, what is the how concerned are they about COVID? And then that is overlaid on top of the blue line to show what is the confidence in general from the University of Michigan confidence survey. And you can see that the confidence is dropping at a greater level than by quite a bit than those who are concerned about COVID in particular. Gasoline prices. Uh, I filled up my truck yesterday and I realized, boy, prices are definitely up. And you feel it at the pump. I'm sure you probably do. You don't need this chart to tell you that. It costs a lot more to fill up your tank than it did just a short while ago. It's going up and up. That's due, of course, gas prices are up. Why are they up? Of course, inflation's up, but the impact of prices because of the Russia Ukraine situation is driving all energy prices up. I thought I would break this down. I just took a couple of states. I wanted to show you by state. I came from the state of Washington. So, and I'm assuming there are people from the state of Washington who are watching. So, in the state of Washington, this came from AAA. It shows the average price. And this is not, in a particular area in the state, but for the state in general, the average price of gasoline. This is for regular. Um, the red bar shows you the state of Washington, and the blue bar shows you the national average. I have two uh, sections to focus on. The one on the left is the current average. This shows you the degree to which the state of Washington is higher than other states. And then you look at the one on the right, and that's 1 year ago. Now, I thought that since Washington is a high tax state, I thought, well, that's all taxes. Well, it's not, because I went through and looked at numerous states, and I realized that there are states that have average taxes, but their prices are down. They're paying less for gas than uh, some other states, and vice versa. So the uh, part of it is taxes, and the average gas tax in Washington State is 52 cents per gallon. Um, I'm going to show you Montana next, and Montana's 32 cents, which is actually pretty high because there are some states that go actually down into the teens. So Montana's maybe a little bit above average, but the state of Washington is higher. But there are other factors that are causing Washington to be higher. I don't know what they are, but this just gives you a comparison And then I'll show you next the state of Montana. Montana is slightly below the national average, but in taxes, they're not slightly below. So there are other factors in play. But the main point I want to make is the comparison between the left side of the chart and the right side of the chart. You can see a definite increase. Now, when you get the consumer price index, which we'll get to later, that excludes food and energy. So all of this, if this were priced into the consumer price index, of course, we know that would be higher. But this is excluded. The I want to get to now. That touches on inflation, and I want to show here that the inflation from the NFIB shows that their concern is that inflation is the single most important problem, higher than 2008. But if we went all the way back to the late 70s, I don't know where that number would be, relative to that if they had done a survey at that time. But you can see relative to the recent past, in this case, 20 years, it's higher than at any point um, in the last 20 years. So as we look at inflation, I've shown you this chart before, and this is updated as of today. The What has happened? There are many contributors to inflation, but one of the contributors is the amount of money in circulation. The more money there is in circulation, the more money there is chasing goods and services, which is forcing those prices up. There's a finite amount of goods in particular, and the and if there's more money chasing those, that is going to be inflationary in prices. You can see from the gray line on the right side of the chart is vertical. You can see that that's when the expansion of currency began. Now, I don't call it the printing of money because they don't print money to put more money in circulation today. They print money to replace money that is coming out of circulation. To put money into circulation, they literally type it into the computer and hit enter, and poof, there's $1 trillion. And that's the way money is entered and expanded. Very quick, very easy. You can see this goes all the way back to 1980, and you can see the rate of change, the amount of money in circulation gradually increasing. And of course, that's inflationary, but it's gradually inflationary. Keep, inflation at a lower level. But when you expand the circulation of money this fast, this much, it is clearly inflationary. So part of it is the more money has gone into circulation. I've shown you this chart before. This is from shadowstats.com. I'll include a link to shadowstats.com. This is on the home page. So if you're on the site, you scroll to the bottom of the home page and you'll see this chart. If you click on the chart, it'll give you two views. This is one of the views. I put an arrow in here to show you what the Bureau of Labor Statistics from the Department of Commerce is illustrating. That's the red line. John Williams, economist who runs shadowstats.com, has done the research. You'll see it on the website, white papers which document the real rate of inflation if you put back in food and energy and the items which they substitute a higher priced item, or if something becomes too expensive, they substitute a lower priced item for it. Those three components, food, energy, and substitution, account for the difference in those two lines. So the real rate of inflation, according to shadowstats.com, which has documented all of this, is over 15%, about 15.5%. When you hear that they say inflation, they're alarmed that inflation is at 7.5%. They were expecting it at 7.3. They no longer say excluding food and energy. They never said, and we have substituted cheaper items for more expensive items. They never say that, but that's documented and it's actually on their website. But they don't even say excluding food and energy. I remember they used to say that. They don't even say it anymore. They've now become accustomed to the fact that the red line is in fact the rate of inflation, and it's absolutely incorrect. So when you hear inflation, CPI, and you hear 7.5 or whatever it is next month, add approximately 8% to that, and that will be the real rate of inflation. So while we're talking about this, you can see, you saw in that previous chart, you saw the amount of money in circulation has increased so rapidly in the last couple of years. You can look at this chart and see the reflection of expansion of money supply with the cost of goods. And whether you're looking at the blue line or the red line, they both have risen rapidly since during the same period of time that there has been an expansion of money supply. This is a chart showing is from the Bureau of Labor Statistics, Macro Bond, and ANZ Research. They've done a historical, just a brief history going back to the beginning of 2019, and it shows the rate of inflation, and they break it down into different categories. And the point of the article and the chart is that they are saying that they believe that inflation is here to stay and will at a multi-decade high. Multi-decade caught my attention. That's got to mean at least 2 decades. That means at least 20 years. Now, that's their opinion. They're a research firm, but they believe that it is not like, I'll say, the late 1970s, where it went up very high and then it began to decline. There were, you know, economic policies um, that were put in place, monetary policies put in place to counteract that, and it came down fairly quickly. They're saying that is probably not the environment we're in today, and that is here to stay. Uh, Several months ago, I covered Russell Napier, who's a financial historian and who's regarded around the world as an excellent resource for historical financial data. And in the interview, David McIlvaney interviewed him and said, "What is your opinion of how long, if we have inflation, how long is it going to last?" Russell Napier said, based on historical data that he has accessed, he's calculated that he believes inflation will last a decade to a decade and a half. So that's 10 to 15 years. That's not too inconsistent with this chart and with this article, which said inflation is here to stay at a multi decade high. What does that mean? That means that the buying power of the dollar is going to decline a lot, month after month, year after year. It also means that from an investor perspective, if you've got inflation truly running at 15%, or let's say 10% plus, or let's say 10 to 20%, whatever number you want to use, that means traditional methods of investing, buy and hold investing with stocks or stocks and bonds, are not going to cut it. They do not get those kind of returns. They're way down into single digits and are often disappointing to investors. Um, and with bonds now declining in value, government bonds declining in value, the picture may look even worse. So this is trouble for the traditional financial advisor who believes in just investing for the long run, staying the course, buy and hold investing. It is just not going to work. So the decline of the buying power of the dollar, it looks like, is here to stay for quite a while. The Federal Reserve is made up of regional offices There is the Federal Reserve, which is made up of the governors, the presidents of those offices, and the St. Louis Fed regional office is headed by James Bullard. And he uh, recently said that he backs a supersized hike and seeks a full 1% increase in the federal funds rate by July 1. You may say, well, what does that mean? Well, I'll show you in just a minute. But that freaked the markets out. And this is the futures chart on, you can see this was on February 10th. And you could see when the Department of Commerce, Bureau of Labor Statistics came out with the CPI number, which was 7.5, excluding food and energy. They and it came out at 7.5. It was expected to come out at 7.3, so it was a little bit worse than expected. Already a high number by previous standards. And then James Bullard came out, and this shows when he said that, and the markets just dropped because they had not factored that in. So the equity markets declined rapidly, and this happened last week. So going back to a couple of weeks ago, Bank of America said they expect seven, seven rate hikes this year. They don't normally, I don't know when they ever did that before, but seven rate hikes. And following Bank of America saying that, then here is the survey of economists, and they are saying that it is based on the survey, 92.8% of those surveyed believe that there will be a 1.75% total federal rate increase in 2022. This means seven 25 basis point hikes this year. If you go back just 5 months ago, that was about 10% of them believed there would be seven hikes. In 5 months, it's now 92%. What this means is bond prices and bond fund prices are coming down rapidly. They have already begun coming down. When I say bonds, I mean government AAA rated treasury bonds are continuing to decline and are a problem, a big problem for traditional investment portfolios that include bonds, with the hope that the bonds are going to soften the equity risk. They're not. So as equities have come down, bonds have come down with them instead of going back up. And that foretells, in my opinion, a bad picture for the future of those who use buy and hold portfolios. This just is a chart that shows what those increases look like at the end of the chart. If we were to have seven increases, this is how it would go. I wanted to give you a historical perspective, a longer, not a 2 or 3 year perspective, but a longer perspective going back to the year 1694. And this is the Bank of England data, because their data goes back that far. It tracks with the US markets, the Federal Reserve, but since the Federal Reserve's only been in existence a little more than 100 years, we can't go back as far as the Bank of England can. But it's a very good measure for what is going on in the US currently and would have gone on historically. I put on the chart at the very right of the chart what 1.75% looks like historically. So you can see if the Fed puts in these seven hikes and goes all the way out to 1.75%, you may say, well, that doesn't sound like a big number. Look at where it is historically. It's not a big number, but you saw what the markets did when it was announced. when James Bullard said he just wanted to get a 1% increase by July, it freaked out the markets. And the part of the fall of the market, equity markets in January and early the first part of February, has been two things. One is Russia, Ukraine, and the other is inflation slash interest rates and rate hikes intended to counter inflation. So this this is not going to look good for both the bond markets and the equity markets. It's only just begun, in my opinion. Okay, so why do the bond prices or the bond fund prices or the bond ETF prices, why are they in such decline? Well, here's why. Because the yield on the bonds is going up, and you can see it is going up rapidly. As it goes up, the price of the bonds and the value of the bond funds, ETFs, is directly or is inversely correlated, negatively correlated with the yield. So yields go up, bond fund prices go down, and vice versa. So with a rise in bond in yields, and do you think interest rates are going to go up further? Look at this. The average, approximate, in my opinion, average over 300 years is somewhere around 5%. 5% average interest rates, which correlate very closely with the yield on bonds. So you can see there is quite a ways to go just to get back up to average. And you're already seeing what is happening to bond fund prices. I'll show you that. This goes back to, let's see, the beginning of the chart is December 3rd, 2021. So this is a little over 3 months. In 3 months, the ETF, Exchange Traded Fund, TLT, which is the 20-year Treasury bond, look at where it has gone. Stock prices from January 2nd forward have similarly dropped. At a time when you expect bonds to hold up equity prices, that's not happening. They're collapsing too. So when Alan Greenspan and others are talking about there is a double bubble, stocks and bonds, and they are both going to collapse together, according to Alan Greenspan and others, are saying a bubble has formed and they are both going to collapse. This is already beginning to show that when the rates are going up and bond prices are going down. So I've said there are two things that are impacting the market. This is what the media is reporting, so I think it's probably correct. The one is inflation slash interest rates intended, the rising of interest rates, particularly by the Fed, intended to counter, to soften, to counteract the decline, the escalation of inflation. And so reaction to that is part of it. And the other part is the Russia-Ukraine conflict. Concerns were rising. This actually came out yesterday morning on Yahoo Finance. And later in the day, this came out. A sliver of hope. The Kremlin sees a diplomatic path on Ukraine. I read several other articles from major media sources that were also saying the same thing. So, what happened today? Equity markets began to rise. By the way, bonds prices are still falling, but you expect that when stock prices go up, you expect bond prices to go down. You just don't expect them to go down together. But the equity markets are seeing this as good news. Now, I do not know if this is going to last, and if there is, when it gets geopolitical, who knows? We don't have access to that information. And so if the Russia-Ukraine situation escalates, and it may, if it does, then I'd say all bets are off and the equity markets are going to continue their path downward. But I wanted you to see, if you look and see that today, so far, the equity markets are rising. You may say, well, why is that happening? I thought, things were horrible. Well, it's probably because of news like this. And maybe it's because prices got so cheap that some people just came in and started buying. And when they started buying, those who were shorting the market had to cover their shorts. And those are the kinds of things that force equity markets up in the short run. If you looked at the beginning, the first week of February, you would have seen that the market went up for about a week. It was a nice rise, and there were people who bought into it thinking, oh, yeah, the market is going back up. We're done with that January decline. Not so fast. This last week, they turned around and collapsed again. And that's the way bear markets happen. They go through these periods of decline, and then they try to rally, and then they collapse because they're not ready to rally. And we don't know. Is this the beginning of an uptrend that is going to be the next upward market? It's possible, but we don't know until we see more. We wait for confirmation, and one day is not confirmation. So it's nice to have a positive rise in the equity markets, but we need more than a day to say you're in a trend. Okay, I took this view. This is the view as of yesterday, and this shows the six major indexes relative to their moving averages. So on the left side of the chart, you see the exchange traded funds listed and then described. And then to the right of the chart, you see where they are by a color code relative to those moving averages. And these, you could say, are indicators of the market. The over on the right side, you see the 20 period simple moving average, the 50, the 100, and the 200-day moving average. These are all expressed in daily terms. On the left side of the chart, you see QQQ, which is the Nasdaq 100, primarily growth stocks. S&P 500 represented by SPY, IWM is the small cap index, and DIA is the Dow Jones Industrials. And then I have two foreign indexes covering the two major types of foreign markets. EFA is the developed countries primarily, and EEM is the ETF for emerging markets. And you can see they're all, as of yesterday, they are all below the all four moving averages, with the exception of the small cap. It is up above its 20-day moving average. So definitely, this is not an indication of a growth market. I'm going to show you some. These are relative strength charts. This shows the S&P 500 represented by SPY, and the inverse of the S&P is the denominator represented by the ETF SH. And so on a relative basis, it shows the direction of the market for the S&P relative to the inverse of the S&P. So at the end of the chart, you can see from December forward, it has been in a period of decline and is now below its 20-period moving average. This is a weekly chart, so every movement represents 1 week of movement. So it is a little bit more of a macro view. It's a 1-year chart, weekly changes. And you can see from a macro point of view, again, this represents, in my opinion, bearish conditions. The small cap, while it has now gone up above on a daily basis, up above its 20-period moving average, on a weekly chart, it has not. And you can see for the last 10 months, probably almost 11 months, the small caps have been in decline relative to the S&P. If they went up, they went up less than the S&P. If the S&P declined, they declined more. So this is not a period of time that so far is indicated to invest in small cap stocks. And by the way, traditional financial advisors believe you need a little bit of everything in your portfolio, including small cap. So they would have some of this in a portfolio, even though for a prolonged period of time it declines. So when people in traditional portfolios say to me, why are my investments doing so badly? This is just one of the reasons why. And of course, we've already covered bonds. This is the Nasdaq 100 index relative to the S&P 500. So you can see all the way back to mid-November that the Nasdaq 100 has been in decline relative to the S&P 500. It's been weaker. So if it went up less than the S&P. If the S&P went down, it went down more than the S&P. Again, you can see this more easily on a weekly chart like this. And of course, you can see where it is to its 20 period moving average, and it's way below. And you saw that on the previous charts that it's red in all categories, below all moving averages. Now we jump over to bonds. We've talked about the decline of bonds. And again, going all the way back to November, you can see that TLT, that 20-year government treasury bond, is weak relative to the inverse of it. So basically, it's a bearish indicator on bonds, but we've seen the chart since going back to early December, and you can see here basically says the same thing. This is a chart put out by Asbury Research. This covers the flow of money by country. And what this is telling you, and this is changes, it's pretty dynamic. So it shows the last week, the last month, and the last quarter. But you can see the money is by and large, with almost without exception, is flowing out of the US and flowing into other countries. There's about 20 countries here, and some the Eurozone and the Pacific zone, emerging markets, etc., that are a collection of countries, but then there are specific countries listed, and you're seeing that from the flow of money, big money, that money is moving out of the US into other countries for some of the reasons we've talked about. Maybe it's the inflation issue, interest rate issue to counter inflation. Maybe it's the Ukraine issue. You really don't know. All you can say is the U.S. is not, for these time periods, has not been an attraction for money. That can change. So since the first column is the weekly, or second column is the weekly, we could see even next week that money starts to move back into the U.S. And this chart can look very different. But for during all three of these time periods, flow of money has gone out of the U.S. Now, I want to cover this is staying from an investment perspective. Now, I get down to sort of portfolio questions, and I want to cover this in some detail. 3 questions for investors. Now, this would be whether you manage the money yourself or you have someone else manage it. These are 3 questions you as an investor need to ask. What kind of loss can you tolerate? Because in investing, you're going to have losses. You know this. You're going to have losses. They're going to be shallow losses, medium losses, or deep and prolonged losses. Which kind do you want? Which kind can you tolerate? Most people that I talk to, when I look at their portfolios, if I were to put, I'm a chart person, so if I put their portfolio on charts or put I can actually, with software, I can replicate their entire portfolio and allocate it exactly the way they're allocated. If I do that, and then stretch it out over a long enough period of time, you can see on any portfolio how much risk is contained in that portfolio using historical data as a way to measure it. We don't know the future, but we can say that kind of portfolio has responded in the past this kind of way. But the question for you as an investor is, what kind of loss? Are you willing to accept a small loss or a deep and prolonged loss? And if you need help determining what kind of losses your portfolio has gone through in the past, give me a call or send me an email and I will construct it for you and show you what kind of loss that you have endured or that the current investments would have hypothetically endured for a long period of time. Is it a 10%, 20, 30, 40% or more loss historically? I say, because I believe in historical cycles, let's just say it's a 30% loss. If you've had a 30% loss in the past, that's probably in your future. If during 2008 you had a 50, 60% loss, that's probably in your future. Number two, you take the question of loss compared to how much return are you expecting. You may say, I want to design a portfolio with very low loss. I'll take a 1 or 2% loss and I want a 10% rate of return or even a 5% rate of return. I don't know how to construct that kind of portfolio. That's unrealistic. So the answer to the second question has got to be relative to the answer to the first question. You say how much loss you're willing to accept, then you say historically, what kind of return are you expecting or have you hypothetically achieved? Those two have to have some degree of parity. There's got to be a relationship between those two. So if you're looking for a 10% or greater rate of return or a 15% or greater return, how much loss are you willing to accept? What kind of loss are you willing to accept to get that rate of return? We've just gone through January and early February. Maybe the market, let's just say it went down 10%. Depends which index you're looking at and exactly what period of time you're measuring. But let's say it was about 10%. Were you down 10%, 15, 20? Were you down 5%? Our portfolios were down in general around 5%. The market was down around 10%. Say, okay, am I willing to accept that? You have to decide. But then you say, and what kind of return am I expecting to take that kind of loss? The third question, this is a question which is not often asked. Can you take a macro view and look out to the end of the cycle that you're in? If you're in a positive market environment where the market is going up and going up and up, can you look to the end of that cycle and say, it's not going to go up forever? It's going to decline at some point. And when it declines, are you prepared for that? Because that's not going to last. When the market goes down and goes the other way, the same question. Can you take a macro view and look to the end of the cycle? This comes back to how is your portfolio constructed and what kind of loss is likely to occur if we have a horrible environment. That's going to happen. When I look back over the last 220 years, go back to 1800, according to my calculations and the website Wikipedia, there have been 22 market crashes where the market has declined 30% or more, and some have declined a lot more than 30%, and 22 times in 220 years. Do the math. That is about once every 10 years, there is a deep decline, a crash in the market. We have not really had one of those unless you count 2020, which was very brief, but since 2009, 2008. And so 12, 13 years, we have not really had a sustained deep decline. But I say that's in our future. So can you look to the end of that cycle and say, what does that look like? The last one, 2008, began in October of 2007. It ended in March of 2013. It went for 5.5 years before the market got back to where it started. That's what I mean by looking to the end of the cycle. That extracted a lot of pain or produced a lot of pain, extracted a lot of money out of portfolios. If you were a traditional investor, that probably didn't go well. But can you look to the end of the cycle? If you're an emotional investor and you think, I should buy this, I should buy that. When they're down, I'm going to buy this or sell that. And when it's up, I'm going to do something. And there's no methodology. That's hard to track. People who do that sometimes work off of their news related and their emotion related. Generally speaking, the people I've talked to have done anything close to that, have done poorly in their investments, and have a horrible emotional ride when trying to deal with it. So if you have a methodology, whether it's a buy and hold methodology or it's active management like we do, you need some kind of method to be able to go back and test that over a period of time to say, hypothetically, what did that look like? So now I'm going to take us to a look at the method that we use to design portfolios in the periods of time that we call risk off, which means we're dealing with negative market conditions. When the market is declining and going down deeply and maybe going down quickly, and we're in a risk off environment, what does that look like? So I'm only going to look at those periods of time. In this particular market, we went risk off on January 7th. We are still risk off. That doesn't mean we're out of the market. We're invested, but in our model, I'm going to show you how the model works. This is how we do it and why we do it that way. When I look at the 9 previous negative markets, they're not all what you'd call bear markets. They are negative markets. There are some bear markets. We'll look at 73, 74 bear market, 77, 78 pullback, and then the market continued on down for another bear market, 81, 82, and then Black Monday in 1987 when the stock market declined 25% in a single day. 1990 and 1998 pullbacks, and then the 2000 dot-com bubble burst and the global financial crisis in 2007 to 9, and then briefly the brief pullback in the March of 2020 COVID pandemic. All 9 of them, and then you'll see why we've designed what we do a particular way, and why I say the kind of loss we're willing to accept is a small loss. I am not willing to accept a deep loss. I do not know the future, but I've designed these so that it meets my criteria of I'm not willing to accept deep declines. So we'll go through these. I'll go through them briefly. There'll be 9 of them. I'm just going to cover them briefly. So if you see the black line at the bottom, that is the S&P 500. If you see the brown/red line, I'll call it brown, at the top, that is the methodology that we use in bear market conditions. And what that does, now think about this, what that does is when equities are declining, we may decline with equities if we have a partial investment in equities. And that exactly has happened for the last 6 weeks. We had a partial investment in equities, and we declined partially. We went down about 5%. We declined partially with the market. I'll show you how that looks. There are times where when equities are going down, something else is going up. For example, I think there are four defensive asset classes. These are called asset classes. They're very different than equities. We think in terms of the stock market, which is equities, but commodities, which is heavily oriented to energy, which is related to oil, is sometimes inversely correlated. The last month and a half, it's been inversely correlated. It's gone up, and equities have gone down. Precious metals, sometimes, not always, but sometimes precious metals will go up and equities go down. Precious metals did a very good job of holding their value during the last 6 weeks and have now started to increase in value. And then treasuries. Sometimes treasuries go up. Even though treasuries are on a downward decline, we may have short periods of time that may last for a week or a few weeks or even a month or two, where during a deeper decline, they're actually rising. So the methodology we use is to shift on a monthly basis, gradually shifting from one type of mixture of defensive assets and sometimes offensive assets. We'll have a mixture and we shift that monthly. So you will see on this chart, there are dots along the way. This chart lasted for 3.5 years or 42 months. So there were 42 dots on each of those lines. So you can see this is not perfect, but it is designed to avoid deep declines. The next chart is almost perfect. This is the 77, 78 pullback. I do not expect this in the future. How perfect would life be? It's nice to have had this on a simulated basis in the past where it adapted to those conditions so perfectly. No, I don't expect that. But it is what happened on a simulated basis using this adaptive model back in 77, 78. So the market did decline, and this didn't much. But if you look at the beginning of the chart, you will see what our January did look like. And the January declined less than the market itself, but it went down. So my third question was, can you take a macro view and look to the end of a cycle to see what methodology do you have and how is it constructed? To say, if I go all the way to the end of a cycle, regardless of which bear markets you relate to, or compare to, you how is it going to do during those cycles, or likely, or how has it done in the past? This might be a good example of what we experience more in January and February. Let's just say February becomes negative. If it did, this is deeper decline. This shows that this particular approach had 2 months of losses, but they cut those losses by about 50%, very similar to what we have done for the last 6 weeks. But then if you can look to the end of the cycle, you can see, well, we would have in this approach some declines, and about in the middle of it, 3 months of declines, but much, much less than the market. The question is, what kind of declines are you willing to accept? What kind of losses are you willing to accept? And can you look to the end of the cycle to see what that would probably look like or what it has looked like in the past? Another example, 2 months of declines. This was 1987. You can see the methodology shows 2 months of declines, less than even less than half of the loss of the market, but still endured declines. But then began an upward, generally speaking, an upward trend out of that decline. 1990, 1998, Again, very similar. And then the 2000 to 2002 dot-com bubble burst. You can see there's periods of where it increases and there's periods where it decreases. But in general, I look at my own philosophy, and that is I am not willing to accept deep declines. That is my goal. That is my philosophy. And with that philosophy, that's why using this approach is attractive to me, because I have confidence that in the future, the methodology will shift from asset classes away from equities into other asset classes, which in fact are starting to increase in value rather than decline with equities. And that's, in my opinion, the only way to avoid deep and prolonged declines. And as I've already talked about with bonds going down and equities going down, if we're in for a deep and prolonged decline, I don't see treasuries being much help. And I think so now, I think it's maybe more true than ever that the traditional portfolios are going to be in for a deep decline whenever that does happen with the equities and bonds together. 2007 to 2009, not perfect. There were periods of loss, periods of even, I can even see 3 months of declines once, and sometimes of 2 months of declines. I can accept that because that's the kind of loss I'm willing to accept. I'm not willing to accept deep declines. And then COVID pandemic, very similar, same thing. I'm going to cover, shift gears, talk about gold and silver. These are prices as of yesterday. Um, Gold and silver did an excellent job of holding their value approximately during the last month and a half. So people who have are invested in the hard metals, or even in GLD and SOV, I think during the last month and a half, those were have provided a cushion for equity risk. The prices now have now started to rise. Uh, the compared to 2 weeks ago, gold is up 3.1% and silver is up 6.7%. Not exactly the picture you have of equities. So they do hold their value over time. They do hold value relative to the buying power of the dollar. And they have historically done that for thousands of years. There are short periods of time where they decline. But if you look at the macro view over time, they have in fact held their value. And I've given some resources down below for checking prices, and give Northgate Precious Metals, Northgate Coins in Seattle as brick and mortar, and then Pacific Precious Metals in California. Both are resources, and I use Monex for checking live prices, kind of on an app, I guess. Next week, I'm going to. I did this with my son Preston. He was here, and we went through the my coin collection, and of course, I have a lot of precious metals, and I also have collectibles, some coins, a lot of coins, and we went through those, and we also went through some currency. So I have some very old currency. And he noticed some things on the currency that I had not noticed. The currency goes back, some of it goes back longer than 150 years. I think we saw one that went back 180 years. And some of those old bills actually have signatures were done. We see a signature on our currency today. Those are done by machines and printing presses. Back then, they didn't use that method for signing. They actually signed each bill with a fountain pen. And I'm going to show you pictures of those, and you'll see the fountain pen ink on every bill, but you will find some print on those bills, which I think is very telling. And it makes currency from 150 years ago, there's a lesson for us today. And when that I saw that and it dawned on me, I thought, I've got to show you this. So next week, I'm going to cover this and I'll show you some pictures from my collection of the currency that goes back a long ways. And we'll look at the lessons that there are for us today in paper currency. Finally, the book is called The Big Reset. And I recommend this book. Willem Middelkoop is a Dutchman. He wrote 3 books in Dutch. None of them were translated into English. And then he did this one, which is a compilation of the key elements of his first 3 books. I read this book it was published in 2014. That's 8 years ago. I read it right after it was published. And I went through it. I went through my books and I saw this and I realized I need to tell you about this. It's not a long book. It's less than 200 pages. And it is very simply written. It's easy to understand, I think, and it covers all of the concepts I'm talking about. Everything from currency devaluation, of course, precious metals, inflation, the Fed, um, Bureau of Labor Statistics, how they report all the things we're talking about on shadowstats.com. He documents all that from Holland. From Holland, he's documenting what's going on in the U.S. And then finally, he gets to the end of the book and he talks about, so what's the end game? Where do we go from here? Things are a mess in the US and in other countries with our currency, with our Treasury Department, and with our Federal Reserve Central Bank. Where do we go from here? And he lays it out. I don't think he knew in 2014 that what he was saying would take 8 years to come about to come about. But if he wrote this book last year, it would be on people's minds, and I'm telling you, he would probably have sold a lot more books. Uh, it is exactly what's happening today. Everything he's talking about related to currency, coins, debt, printed money, all of it, inflation, all of it is coming about. It just took 8 years to get there, and but it's maybe it's the 1984 or 1984 of financial books, but it is, I highly recommend it. I'll provide a link to it on Amazon below if you want to buy it. But for the average investor, for a person who doesn't want to get steeped into a lot of financial lingo, it's an excellent book. Thank you for watching. If you like this, I appreciate you giving me a thumbs up. Uh, we do not do ads. If they put an ad on at the beginning, I don't have control over that, but throughout, we do not accept ads. But it does help me in the circulation if you give me a thumbs up if you like this. And if you have questions or comments, I will check those. I appreciate those who have commented before or who have had questions. I appreciate those and feel free to do that. I will see you for a short version next week, and we will cover just the stock market, and I will cover the 150-year-old plus currency and lessons we can learn from that today.